What if I told you that Bitcoin could theoretically be taken down with just $8 billion? It sounds almost impossible. After all, Bitcoin has survived for more than 15 years, overcoming government bans, the collapse of major crypto exchanges, trillion-dollar market crashes, and countless headlines claiming that Bitcoin was dead. Yet one Duke University finance professor has proposed a very different perspective. According to him, the biggest threat to Bitcoin may not come from governments, hackers, or even regulators. Instead, it could come from something much simpler: economic incentives. He argues that the rapid growth of modern derivatives markets has created an entirely new scenario, one in which attacking the Bitcoin network could actually become a profitable business. This is not a prediction that Bitcoin is about to collapse, nor is it a conspiracy theory designed to spread fear. It is an economic hypothesis based on how today's financial markets operate. So how does this theory actually work? Could an organization really shake the world's largest cryptocurrency network with roughly $8 billion? Or is it simply an interesting idea that sounds convincing on paper but would never happen in the real world? Let's find out. Today's video is sponsored by MegaPro. MegaPro gives you cashback rewards from leading exchanges, exclusive promotions, powerful trading tools, and a growing crypto community, all in one place. Visit the website now to explore all the benefits and start maximizing every trade today. To understand this theory, we first need to understand what actually protects Bitcoin. Unlike a traditional bank or a centralized server, Bitcoin is secured by millions of mining machines distributed around the world. These miners continuously compete to verify new transactions and add them to the blockchain. The more computing power that participates in the network, the more difficult and expensive it becomes to attack. However, the system has always contained one theoretical weakness that Satoshi Nakamoto himself mentioned in the original Bitcoin white paper back in 2008. If a single entity were able to control more than 51% of the network's total hash power, it could create the longest blockchain and temporarily gain control over transaction ordering. That wouldn't allow the attacker to create new Bitcoins or steal coins from other people's wallets, but it could enable double spending attacks and the reversal of recent transactions. Even the possibility of such an event could seriously damage confidence in the network. For years, researchers believed this scenario was practically impossible. Acquiring enough ASIC mining hardware, building massive data centers, and securing the enormous amount of electricity required would cost billions of dollars. But even if the attacker succeeded, Bitcoin's price would likely collapse because investors would lose confidence in the network. In other words, the attacker would destroy the value of the very asset they had spent billions trying to attack. That's why a 51% attack on Bitcoin was long considered economically irrational. It only made sense if the goal was political sabotage or geopolitical disruption rather than financial profit. According to Professor Campbell Harvey, however, one major development has changed the equation: the growth of modern derivatives markets. Today, investors no longer need to own Bitcoin to profit from a falling price. They can simply open massive short positions. Harvey argues that a well-funded organization could theoretically prepare a network attack while simultaneously building large offshore short positions. If the attack triggered panic and Bitcoin's price collapsed, the profits from those short positions could potentially exceed the cost of carrying out the attack. That is the key difference. The motivation would no longer be ideology or politics. It would simply, not everyone agrees with Professor Campbell Harvey's theory. Shortly after his research gained attention, many Bitcoin developers and blockchain security experts raised several important counter-arguments. The first objection is that the real cost could be far higher than $8 billion. Controlling more than half of Bitcoin's global hash rate would require far more than simply purchasing mining machines. An attacker would also need enormous data centers, reliable power infrastructure, industrial cooling systems, and a massive operational workforce. Building an operation on that scale would rival the infrastructure of the world's largest technology companies. Second, it would be extremely difficult to keep such a project secret. Ordering millions of ASIC mining chips would almost certainly be noticed by manufacturers and suppliers. Constructing multiple large mining facilities would also leave a visible footprint. Long before the attack could begin, the Bitcoin community would likely recognize that something unusual was happening. Even if an attack were launched, the Bitcoin ecosystem would not simply stand still. Core developers, major mining pools, exchanges, and infrastructure providers could coordinate emergency responses. Throughout crypto history, several blockchain networks have upgraded their software or even executed hard forks to recover from serious attacks and technical failures. Some analysts also argue that governments could become involved if an attack of this magnitude ever occurred. Bitcoin is now a trillion-dollar asset held by institutional investors, publicly traded companies, and even sovereign governments. A successful attack would no longer be just a crypto problem. It could become a broader financial stability issue. There is also another factor that is often overlooked. Financial markets constantly react to new information. If investors noticed unusual purchases of mining hardware or unusually large short positions building in the derivatives market, Bitcoin's price would likely move long before the attack actually happened. That alone could dramatically change the economics behind Harvey's original scenario. For that reason, many experts believe the $8 billion theory should be viewed primarily as a risk management exercise rather than a realistic prediction. It serves as a reminder that no financial system is completely immune to risk, not even one as decentralized as Bitcoin. Interestingly, after discussing Bitcoin's potential risks, Professor Campbell Harvey does not sound pessimistic about blockchain at all. In fact, he believes the technology is entering its most important phase since Bitcoin was first introduced. According to Harvey, blockchain's greatest opportunity may not be creating another digital currency. Instead, it could be transforming real-world assets into digital tokens that can move instantly across global networks. Imagine a future where stocks, bonds, gold, real estate, or even ownership of artwork all exist as blockchain-based tokens. Instead of waiting days for bank transfers, paperwork, or financial intermediaries, transactions could settle within seconds and operate 24 hours a day, 7 days a week. The clearest example today is the rapid growth of stablecoins. Unlike Bitcoin, stablecoins are typically backed by cash reserves or short-term government securities, allowing them to maintain a relatively stable value. In just a few years, they have become an essential part of the global digital payment system, moving trillions of dollars every year. Harvey also believes artificial intelligence will accelerate this transformation. Future AI agents may not simply answer questions or generate content. They could negotiate contracts, purchase digital services, pay invoices, and transact with other AI systems entirely on their own. To function efficiently, these autonomous agents will require payment networks that are available around the clock, inexpensive to use, and capable of settling transactions almost instantly. Those are precisely the strengths that blockchain technology and stablecoins can provide. Whether the $8 billion attack theory ever becomes reality is almost beside the point. The more important question is what truly gives Bitcoin its value. Is it the technology itself? Is it decentralization? Or is it the trust built by millions of people who continue to use and support the network every day? Bitcoin has repeatedly survived challenges that many believed would destroy it. And perhaps, just like the early internet, the real question is not whether the technology is perfect, but whether it can continue evolving and adapting to the challenges of the future.